You know, in my 40 plus years in banking, I've seen the same financial mistakes destroy more wealth than market crashes, recessions, or economic downturns. At JP Morgan Chase, we work with millions of customers across every income level, and the patterns are remarkably consistent. People make the same banking and financial mistakes repeatedly, often without realizing how much money they're losing. The most frustrating part of my job isn't dealing with complex financial crises or regulatory challenges. It's watching good, hardworking people unknowingly sabotage their financial futures through basic banking mistakes that could be easily avoided with proper knowledge and discipline. These aren't sophisticated investment errors or complex financial planning mistakes. These are fundamental banking behaviors that silently drain wealth month after month, year after year, until they've cost people tens or hundreds of thousands of dollars over their lifetime. At JP Morgan, we track customer behaviors that correlate with wealth building versus wealth destruction. The data is overwhelming. Customers who avoid these 6 banking mistakes consistently build more wealth than customers with higher incomes who make these mistakes regularly. Today, I want to share with you the 6 most common banking mistakes that are destroying your wealth, often without you realizing it. These aren't theoretical concepts. These are specific behaviors I see every day that separate financially successful people from those who struggle despite earning good incomes. Understanding and avoiding these mistakes won't make you rich overnight, but it will stop the financial bleeding that prevents most people from building the wealth they should accumulate over their working careers. The first wealth-destroying banking mistake is paying unnecessary fees and charges. Banking fees might seem small individually, $3 for an ATM fee, $35 for an overdraft, $12 for a monthly maintenance charge, but they compound into massive wealth destruction over time. Most people dramatically underestimate how much they pay in banking fees annually. At JP Morgan, we've calculated that the average customer who pays regular banking fees spends $300 to $600 annually on completely avoidable charges. Over a 30-year career, this represents $9,000 to $18,000 in direct losses, plus the opportunity cost of not investing that money. The mathematics become even more devastating when you consider investment returns. $500 annually in avoided banking fees, invested at 7% returns over 30 years, grows to over $47,000. That's real wealth destruction from seemingly insignificant monthly charges. ATM fees are the most common unnecessary banking expense. Using out-of-network ATMs typically costs $3 to $5 per transaction, plus potential fees from your own bank. People who use ATMs twice weekly can easily pay $300 to $500 annually in ATM fees alone. The solution is simple. Choose banks with extensive ATM networks, use cashback options at retailers, or withdraw larger amounts less frequently. Many online banks reimburse ATM fees completely, eliminating this expense entirely. Overdraft fees represent even more serious wealth destruction because they typically cost $35 per incident and often trigger multiple fees in rapid succession. A single day of poor account management can easily cost $100 to $200 in overdraft fees. Monthly maintenance fees are completely avoidable with proper account management. Most banks waive maintenance fees for customers who maintain minimum balances, set up direct deposits, or use other qualifying services. The key insight is that banking fees are voluntary expenses disguised as inevitable costs. Every banking fee represents a choice to pay for convenience or poor planning rather than managing your finances more carefully. Account selection also affects fee exposure. Basic checking accounts often have higher fees than premium accounts for customers who maintain larger balances or use multiple services. The second wealth-destroying banking mistake is keeping too much money in low-yield savings accounts. Traditional savings accounts at major banks typically pay 0.01% to 0.05% interest, while inflation runs 2% to 4% annually. This means your money loses purchasing power every year it sits in traditional savings. At JP Morgan, we see customers with $50,000, $100,000, or even $200,000 sitting in savings accounts earning virtually nothing while they complain about their inability to build wealth. The opportunity cost is enormous and completely unnecessary. High-yield savings accounts, money market accounts, and certificates of deposit offer significantly better returns with the same safety and FDIC insurance protection. The difference between 0.01% and 4% annual returns is substantial over time. Consider this example: $50,000 in a traditional savings account earning 0.01% grows to $50,015 after 1 year. The same $50,000 in a high-yield savings account earning 4% grows to $52,000, a difference of $1,985 annually just for choosing the right account type. Over 5 years, the difference becomes $9,000 versus $60,833, a $9,833 difference from account selection alone. Over longer periods, the differences become even more dramatic. Emergency funds are particularly affected by this mistake because they represent substantial amounts that sit idle for extended periods. Keeping emergency funds in high-yield accounts maintains liquidity while earning meaningful returns. Many people resist moving money from traditional savings because of convenience or familiarity, but online banks now offer the same services as traditional banks with significantly better interest rates. The fear of online banking is often unjustified because online banks are FDIC insured and offer the same protection as traditional banks. The technology is reliable, and most transactions can be completed more efficiently online than in physical branches. Even within the same bank, choosing the right savings product makes substantial differences. Money market accounts often pay higher rates than regular savings, while CDs provide even better returns for money you don't need immediate access to. The third wealth-destroying banking mistake is poor credit management that increases borrowing costs. Credit scores affect the interest rates you pay on mortgages, auto loans, credit cards, and other borrowing, creating massive wealth differences over time. A 50-point credit score difference can cost tens of thousands of dollars in additional interest payments. At JP Morgan, we see customers with similar incomes paying dramatically different borrowing costs based solely on credit management practices. These differences compound over decades of borrowing into substantial wealth destruction. Mortgage interest rates provide the clearest example of credit score impact. A $300,000 30-year mortgage at 4% interest costs $215,609 in total interest. The same mortgage at 5% interest costs $279,767, a difference of $64,158 from a 1-point rate difference. Credit score differences of 50 to 100 points can easily create 1% to 2% interest rate differences, meaning poor credit management can cost $50,000 to $100,000 or more over the life of a mortgage. Auto loans show similar patterns. A $30,000 auto loan for someone with excellent credit might cost $1,500 in interest over 5 years, while someone with poor credit pays $5,000 in interest for the same loan, a $3,500 difference from credit management alone. Credit card interest represents ongoing wealth destruction for people who carry balances. Credit cards often charge 18% to 25% annual interest, creating enormous costs for people who don't pay balances in full monthly. The most damaging credit mistake is making only minimum payments on credit card balances. A $10,000 credit card balance at 20% interest, paying only minimum payments, takes over 30 years to pay off and costs over $20,000 in total interest payments. Late payments destroy credit scores and wealth simultaneously. A single 30-day late payment can reduce credit scores by 50 to 100 points and remain on credit reports for 7 years, affecting borrowing costs for nearly a decade. Credit utilization, the percentage of available credit you use, significantly affects credit scores. Using more than 30% of available credit limits reduces scores, while keeping utilization below 10% optimizes scores and borrowing costs. The fourth wealth-destroying banking mistake is not maximizing employer benefits and banking relationships. Most people leave thousands of dollars annually on the table by not fully utilizing employer benefits, bank account bonuses, and relationship banking advantages that require minimal effort to capture. At JP Morgan, we offer various incentives for customers who consolidate their banking relationships, maintain larger balances, or use multiple services. Many customers don't take advantage of these benefits despite their significant value. Employer 401k matching represents the most common missed opportunity. If your employer matches 50% of contributions up to 6% of salary, you're earning immediate 50% returns on your investment, guaranteed returns that cannot be replicated elsewhere. A $50,000 annual salary with 6% contributions and 50% employer matching creates $1,500 in free employer contributions annually. Over a 30-year career, this represents $45,000 in direct employer contributions, plus compound growth that can reach $200,000 or more. Bank account bonuses often provide $200 to $500 for opening new accounts and meeting simple requirements like direct deposit setup or minimum balance maintenance. These bonuses represent guaranteed returns for minimal effort. Private banking and wealth management services often provide valuable benefits for customers with larger balances, including better interest rates, reduced fees, and investment advisory services that can improve overall financial outcomes. Relationship banking can provide access to better loan rates, reduced fees, and preferential treatment during application processes. Banks reward customers who concentrate their banking business rather than spreading it across multiple institutions. HSA accounts, if available through employers, provide triple tax advantages that make them incredibly valuable for long-term wealth building. HSA contributions are tax deductible, growth is tax-free, and withdrawals for qualified medical expenses are tax-free. The fifth wealth-destroying banking mistake is inadequate protection against fraud and identity theft. Financial fraud and identity theft affect millions of people annually, often destroying wealth through direct losses, credit damage, and time costs associated with recovery efforts. At JP Morgan, we spend billions annually on fraud prevention because we see how devastating financial fraud can be for individual customers. The direct losses are often just the beginning. Credit damage and recovery costs multiply the total impact. Poor password management creates vulnerability to account takeovers that can result in complete account draining. Using simple passwords, reusing passwords across accounts, or failing to enable two-factor authentication dramatically increases fraud risk. Debit card usage for online purchases or unfamiliar merchants creates unnecessary fraud exposure because debit cards access your money directly. Credit cards provide better fraud protection and dispute resolution processes. Public Wi-Fi usage for banking activities exposes account information to potential interception. Banking should only be conducted on secure private networks or through mobile data connections. Paper statement theft provides criminals with account information that can be used for various fraud schemes. Online statements are generally more secure than paper statements delivered to mailboxes. ATM skimming devices can capture card and PIN information when used on compromised machines. Using ATMs at bank branches rather than standalone locations reduces skimming risks. Regular account monitoring helps detect unauthorized transactions quickly, limiting losses and simplifying recovery efforts. Many banks offer mobile alerts that notify customers of account activity in real time. Credit monitoring services help detect identity theft quickly before extensive damage occurs. Early detection significantly reduces recovery costs and credit score impact. The sixth wealth-destroying banking mistake is poor tax planning and record keeping. Tax inefficiency destroys wealth through unnecessary tax payments, missed deductions, and penalties that could be avoided through proper planning and record keeping. At JP Morgan, our private banking clients typically work with tax professionals to minimize tax obligations legally and efficiently. Many people pay thousands more in taxes than necessary because they don't understand tax-efficient banking and investing strategies. Keeping large amounts in taxable savings accounts when tax-advantaged options are available represents significant tax inefficiency. IRA contributions, 401k contributions, and HSA contributions all provide immediate tax benefits. Poor record keeping for tax-deductible expenses costs money through missed deductions. Business expenses, charitable contributions, and investment costs are often deductible but require proper documentation. Tax-inefficient investment account management creates unnecessary capital gains taxes. Tax loss harvesting, asset location optimization, and tax-efficient fund selection can significantly reduce investment tax obligations. IRA and 401k withdrawal planning affects tax obligations during retirement. Poor distribution planning can push retirees into higher tax brackets unnecessarily, reducing after-tax income. Banking product selection affects tax efficiency. Municipal bonds provide tax-free income for high earners, while different account types offer various tax advantages for different financial goals. Early withdrawal penalties from retirement accounts destroy wealth through both penalty payments and lost tax advantage growth. Understanding withdrawal rules prevents costly mistakes. Estate planning integration with banking relationships ensures proper beneficiary designations and transfer procedures that can save substantial taxes and administrative costs for heirs. Now let me explain how avoiding these 6 banking mistakes works together to create substantial wealth preservation and building opportunities. Each mistake individually can cost thousands annually, but combined they often represent $2,000 to $5,000 in annual wealth destruction through fees, poor returns, higher borrowing costs, missed opportunities, fraud losses, and tax inefficiency. Over a 30-year career, avoiding these mistakes can preserve and create $100,000 to $300,000 in additional wealth through direct savings and improved investment returns. This represents real money that can fund retirement, education, or other financial goals. The compounding effects are particularly important because money saved from avoiding these mistakes can be invested for additional returns. Every dollar saved from banking mistakes and invested at market returns multiplies over decades of growth. At JP Morgan, we've observed that customers who avoid these banking mistakes consistently outperform higher income customers who make these mistakes regularly. Financial discipline often matters more than income level for wealth building. The solution requires education, discipline, and regular review of banking relationships and practices. These aren't one-time fixes. They require ongoing attention and optimization as financial circumstances change. Banking technology has made many of these optimizations easier than ever. Mobile apps, automatic transfers, and account alerts can help manage accounts more efficiently while avoiding common mistakes. Professional financial advice can help identify and avoid these mistakes while providing personalized strategies for specific financial situations. The cost of professional advice is often less than the cost of these banking mistakes. The key insight is that banking mistakes are entirely within your control. Unlike market volatility or economic conditions, these mistakes can be avoided through knowledge, discipline, and proper financial management. Avoiding these 6 banking mistakes, unnecessary fees, low yield accounts, poor credit management, missed benefits, inadequate fraud protection, and tax inefficiency represents one of the most reliable ways to preserve and build wealth over time. These mistakes destroy more wealth for average Americans than sophisticated investment errors or complex financial planning mistakes. Focusing on banking fundamentals often provides better results than chasing complex investment strategies while ignoring basic financial hygiene.